Hey everyone, we are actually live now. My apologies that I had some technical difficulties. I've got a lapel mic now set up and wired into my phone, so hopefully you guys are able to hear me loud and clear. I apologize for the first time getting on here. We had a little technical difficulties. For those 6 people that jumped on, I hope you guys are able to find this live stream now, so we're able to watch live. So today we're going to talk about financial freedom, right? And specifically, we're going to talk about the degrees of financial freedom and what is financial freedom, right? And everyone defines financial freedom and financial independence slightly differently, but there are varying sort of degrees that you can sort of explore, right? There's the person that's sorry guys, this just fell. Move this lamp down so I don't have so much shadow on the camera there. That's better. So there's varying degrees as far as financial freedom goes, and the first thing we got to think about is what is the goal, right? And is financial freedom the actual goal? And if it's the goal, then what do we need once a year? And so that's something that's really awesome about the whole financial freedom aspect there. So hopefully you guys can hear me. I'm trying out a new lapel mic. Got 4 people here. Can anyone hear me on there? Am I coming in loud and clear? Let me know in the comments if you guys can hear me with the new setup. And we've got some lighting set up, so hopefully that's helping and not hurting. Jonas, thanks for letting me know. Okay, cool. You can hear me and everything's good then. Today's segment is going to be talking about, something just fell, with the lapel mic there. We're going to talk about financial freedom, and then specifically we're going into live Q&A. Hey John, how you doing? Great to hear that you can hear me. That's the important thing, is that this lapel mic is doing its job and projecting my sound for you guys onto the live internet for this live stream. So financial freedom, it's really the idea, in my mind, the concept of financial freedom is effectively your basic necessities are covered such that you don't have to worry about, for instance, where your rent is going to come from, or your next mortgage payment, or all your food expenses, or your basic living necessities. You want to make sure that those things are taken care of. And that's really important, I think, because a lot of people go paycheck to paycheck and they're just, all day long just grinding, right? And it's really hard to get out of that cycle, right? To unlock, financial independence and financial freedom. And so when we explore the levels of financial freedom, in my mind, we start at the bottom, right? With someone who's completely the opposite of financial freedom is, they have nothing. They have no resources, or they're in the grinder category. So they're working at a job just to make ends meet day to day. They're saving nothing. They have no passive income, no other source of income except for one active job that they have to work at. Time equals money. And so they have not separated time from money, right? They trade their time for money, and that's all they have. And so that's sort of the bottom rung, right? Is like either you have no financial means at all coming in, or you're working entirely at a day job, 9 to 5. Not that there's anything wrong with that, but when you're trying to be reaching financial freedom, the goal there is that you basically don't have to work, right? You're financially free, and you have that freedom to, for instance, if you need to go on a trip or you want to invest in a business, you have that flexibility and that freedom there to do that. So that's something that's really, really important, I think, when you're striving to try to build the ultimate life. You're trying to design for yourself what is the ultimate and the best lifestyle for myself. And for me, it's always been financial freedom. My daughter and my wife and my family are so important to me, and my friends. I want to focus on them. I don't want to be focusing on trading time for money. And often in the beginning, to climb the pyramid, right, and unlock the different layers of financial independence. So you might be semi-financially free or semi-financially independent. And in that area, you basically, if you think about it, you're working, maybe a part-time job and you have part-time passive income. You have 2 or 3 rental properties that are semi-passive. So you manage them yourself. You don't have for instance, a property management company. You're doing it all yourself. You'd be semi-active. So you'd be, effectively managing some of those requests, dealing with some of those problems, but most of the income comes in without you trading time. You're giving up something like a property that is something you're able to trade for wealth, effectively. So you're not trading your time for wealth necessarily. The relationship becomes such that you're an event-based earner, right? An event happens, you renovate a property, and it creates wealth. You sell something and it creates wealth. As an entrepreneur, you're actually an event-based earner. So you're a little bit higher than someone who's reliant on the 9 to 5 for that income. So that's something I really recommend is, focusing on, when you think about it, guys, if you can have that passive income coming in and your main, bare necessities are taken care of, you're just safe, right? At the end of the day, you don't have to worry a whole lot about, where's my rent going to come from, or can I take this business venture on? Can I invest in X or Y opportunity that's just fallen in my lap? With financial freedom, you basically free up your time, which is your most valuable resource, to do whatever you want to do with your life. And so the ultimate financial freedom is sort of what I've been striving towards. And I don't actually have it because I bring on this sort of pain into my own life by I take on too much. I'm a yes man. So someone will message me and say, hey Mike, I would love to meet up. Would you come take a look at my property? And like, I'll go take a look at their property, or hey, can we go get dinner? I'd love to pick your brain on X or Y. And I just say yes to like everything. And that's the way I've always been. It's just, yes, I'll find a way to fit it into my schedule. We will make it work. And that sort of mentality, okay, Nicholas, I just saw your question come in. I'll get to that in just a sec. So my mentality has been really focused on, at the end of the day, it really does make the most sense to free your time, right? And at the end of the day, hey Gary, how you doing? Welcome to the live stream. Sorry I didn't get off the ground in the beginning. We had some technical difficulties. I've got some new lighting kits you guys can't really see here, but we've got a lapel mic as well. Hopefully it's coming in loud and clear, clearer than it was before with my external mic that I had mounted. So hopefully that's loud and clear. I'm gonna get off and answer this question quickly, and then we can jump back to financial freedom. What are your thoughts on Meet Kevin's opinion on wholesaling? He brings up some good points. Kevin, hey Michael, how you doing? Hey Andre, thanks for joining in. I appreciate you. I appreciate all of you guys jumping in and watching. We have 12 people live right now. But talking about, Kevin's thought on wholesaling, I have some friends that are wholesalers, and, I have friends that are realtors as well. And there's that whole debate, right? Realtors really don't like wholesalers. Wholesalers don't really, there's just a bit of a clash there, and we often see that. Realtors think, because they've got this 2-month course and this license and all of that, and they have these ethical duties, that wholesaling is totally wrong. And I would say it's sort of, my thoughts on wholesaling are specifically, and it depends on the aspect you're discussing, but I think in a lot of cases, wholesalers serve a purpose in the world, right? And it's to a point where I think that, imagine someone who's got a property who, they're a hoarder and their property is full of stuff, right? And they could never list it on MLS, or they have a kitchen that got ripped out and they can't list it on MLS. Like, you can't put that out there as an agent and say, they'd be sued, right, for listing a property improperly, right? You have to just list it as like non-habitable, right? And so non-habitable properties and really damaged properties, wholesalers provide a valuable service in that these people they have often psychological problems, right? And when you think about it, it's not all about the money. Like, the money is not actually as important to us. We talk about financial freedom, we think that's the most important thing, but honestly, money is not the most important thing for a lot of people. I know people specifically in my family and in my life that would say to me like, Mike, I'd rather pay $1,000 more for something if I feel good about it. And so, yeah, I know that sounds crazy, but like, wholesalers serve that whole segment of the market. Like, there's this granny who doesn't know where she's going to live. She's lived in this house for 35 years. She has no idea about the rental market. She doesn't know where she's going to find a place, and she's nervous. She's afraid. She's got stuff she wants to bring into storage. It's overwhelming for her, right? If you give her $100,000 for her house or $110,000 for her house, it makes no difference to her, right? She's already got her retirement accounts figured out. Money is not even a factor. She's retired, right? It's not even a point. So when a wholesaler comes in and offers them, say, 100, you might say, well, that's unethical. The market could get 110. And that might be true. Like, a realtor might be able to get 110. But the truth is, only good realtors really do a good job of that. Like, 90% of realtors are bad realtors. And so those bad realtors might often put up bad pictures and a bad listing, and you may even get less than the wholesaler is offering in some cases. So not necessarily true that realtor will always get more a better price for the property, because that's a lot of what Kevin's arguing, right, about wholesaling. And I think that it isn't unethical if you're solving a problem. If I take this lady and I find her somewhere to live, I solve her problem. I'm like, here's a retirement place where you'd be happy. We take her to a few places. We get her signed up. We get a lease, and I'm actually working to help her through this problem. If I solve these problems, I set up a storage unit for her to, review, put all her stuff into, right? And she reviews all the documents. She's like, this is a great price. I'm happy at this. You've solved all of my problems. No one's going to come through my house. No one's going to, make me feel embarrassed because I have, stuff that's I haven't touched in 30 years in some of my bedrooms. I'm embarrassed about that. I don't want my friends and family coming into this property, right? And if you put it on MLS, those pictures are going to be out there, and my neighbors are going to know. And like, my best friend Joan is going to know that I'm a hoarder, or you know what I mean? Like, my family members are gonna all fight about this. I just want a quiet sale where no one knows that I sold, and I don't have to worry about all the stresses. So in a lot of different situations, wholesalers make a ton of sense. So I don't think the wholesalers are evil. I think that they provide a vital task in society. I would like to see more wholesalers invest in the real estate themselves as opposed to wholesaling the deals. It'd be nice to see them put skin in the game and find deals under market, renovate them, and then transform them into great quality products for the market. I think that's something that I personally like to do. Is I take deals on myself and get involved and invest in those deals. Even if I bring on joint venture partners or I bring on investors, at least at the end of the day, I'm taking an underutilized asset and finding a way to make it better utilized, because you can pay for a property as a 3-bedroom, and if you convert it to a 5-bedroom, now it's worth what a 5-bedroom is worth. So you kind of add, there's a lot of value in that sense, right? And that's something that's really, I think, a key piece in the whole wholesaling game. So, okay, this question is very subjective. How much money or cash would you recommend to save up before investing in a BRRRR property? I would say, I recommend 20% down. I'm a big fan of the 20% down to avoid the private mortgage insurance, especially in Canada, CMHC. Canadian Mortgage Housing Corporation has these exorbitant fees associated with buying a house at, say, 5% down, right, as a first-time home buyer. And the problem with these fees is that they actually are at the outset. So right as soon as you buy, they tack it on. You put 5% down, you pay 4% of the purchase price in a fee. So your 5% down payment is gone. Like if you sold tomorrow from exactly what you bought it for, you'd have no money. Your 5% on your $300,000 house, your $15,000 is gone in fees. That's how CMHC really works. So CMHC only works if you hold long term, right? You're thinking, okay, if I amortize that over a long time, yes, I'm paying interest on my mortgage payment on the CMHC fee, but I get to have this 5% down, I can get this deal that I wouldn't have been able to have before. And my thought is that, if you'd run the numbers on that, you'll find that more often than not, the ROI isn't very good. So if your property is appreciating, I'll walk you through an example. If your property is appreciating, right, even at like 2 or 3% a year, and then you're paying down your mortgage as you pay your mortgage, there's what you call mortgage pay down. So the amount of equity in the property is growing from the debt's getting smaller and the property's appreciating. So you're building equity, right? You start at 5%. You're usually at about 20% down in like 2 years. In the markets we've had, some people in a year have been at 80% loan to value. And so then you want to go refinance, right? But you can't refinance. You're not allowed to refinance in Canada. You can't refinance 95% loan to value. So you get to buy at 5% down, but then when you refinance, you're at, again, 80% loan to value. So all of the value of the CMHC private mortgage insurance is gone within like a year or two. So you're paying 4% of the purchase price as an upfront fee to have the right to buy at 5% down, but in a few years you end up basically losing the value that kind of came about because of the fees you paid. So my thoughts are, go out and get a hard money loan, borrow from your parents at 10%, 15%, even at 18%. If you run the numbers, it's cheaper to borrow your down payment at 18% and have them say they gifted it to you and get a traditional mortgage than going with the private mortgage insurance, because the fees just eat you alive. So that's sort of my thoughts on doing the less than 20% down, the whole CMHC thing. I know I got off on a tangent, but let's get some questions banged out here. Okay.
I'm gonna read them off to you again if you want.
I'm seeing them here. It's just faster if I read them here. Thanks, Andre, for the feedback. Just got your question there. Do I think real estate market in London will eventually become like Vancouver or Toronto? Not in the same way. I think that it could grow in the same way that Vancouver and Toronto did if certain factors came into play. I think that, on the higher end, there's different segments within London too, right? Like the $200,000 purchase price in London, I think will always do very, very well because it's a really affordable housing option. But the $900,000, the $1 million houses in London, they're not really moving very quickly, right? The sale price just isn't there. So we're not seeing the same, we're not really seeing the same movement on price in that segment of the market. But I think London overall, there's a couple trends I think that are helping London a lot right now. And one of the trends is we're in a digital economy, a digital age. So a lot of people work in Toronto, right, specifically, which is like an hour and a half, 2 hours, depending on where you work in Toronto, from London. So you can commute on the train in about an hour and a half. And if you're driving from a suburb of GTA, it's about an hour and a half. And I know that sounds crazy on the map because you're thinking London's a lot further from Toronto, but there are people who commute faster from London than they do from certain areas of Toronto through the traffic. So what we're getting is people are working 1, 2, 3 days a week in the office. They're Monday, Wednesday, Friday in the office, and Tuesday, Thursday, they're at home. So they're only in 2 or 3 days a week in Toronto. Then they have vacations, everything else. They're thinking, I can move to London, sell my house for $1.5 million in Toronto, and buy a house for $300,000 in London. be mortgage free and have a ton of cash and then just be way cheaper lifestyle. And London's an awesome city. It's got a ton of, it's got a lot of youth in the city. We have a lot of great restaurants and things like that. So London is actually a great place to retire and a great place to have a good lifestyle. It's a family city, right? There are a lot of families and a lot of great school districts in London. So families are gravitating to London. And so that's been a catalyst, I think, that people are selling in Toronto and moving to London, or they're looking to invest in London. And they're seeing London as this like haven. Sort of along the corridor all the way to Windsor. It's sort of in the middle, right? And I think London's poised very, very well in southwestern Ontario to do very, very well. It was actually going to be the capital of Canada. It wasn't going to be Ottawa, actually, back in the day. That's a long tangent I'm not going to get on, but London was designed to be the capital, right? It was named after like London, England, right? And we were a colony. And so London is actually a really great city. I'm a huge fan of London, Ontario, Canada. It's a great city for investing. Wow, we have 20 people on the live stream. That is amazing, guys. Thank you so much for joining on. I'm gonna get to every single question. Anyone has a question, like seriously, if you guys just joined in, like shoot me a question. You want to talk about real estate, financial freedom, anything. I'm down to talk about that. I've got accounting knowledge. I've got real estate knowledge. I like to talk about financial freedom. It's just my passion. So we're talking about London and specific trends, I think, of London. One other one is not only the digital era and the digital change where people are working from home now, so they no longer need to live next to work. They can move further away. And so that means that I think Toronto and Vancouver long term, unless other conflating factors like immigration push prices, continue to push them up, I think that those areas will see a decrease, right, in population of the residents who live there. So people living there are moving away, but new immigrants are coming in with money and they're keeping the market propped up and they're kind of keeping the population growing. So I think net migration to immigration is a big piece of how you can determine the local trend of a market. Not only do you look at the economic trends, right, like what sort of jobs are people having in this community, right? If you're in a small mining town like Sudbury in Northern Ontario, I mean, it's a big risk. If the NDP got in, for instance, a socialist government, and they put regulation on mining or forestry, boom, that city's dead. Like there's no employment. But if you're in a city like London, where we have like the largest college, I think, in Ontario, and one of the largest universities in Ontario as one of our huge employers, and we have like a ton of tech companies, and we have a financial center, we have lots of manufacturing, we have a diverse economy of different varying sectors. So we're very, very diversified. And you look at London, I think overall, relatively still affordable. We have a really, really affordable, still an affordable housing. The average house here is $325,000 or so. And there are many pockets in London. You can still buy a single family detached home for 150 grand. So you just can't find that in Toronto and area. So I'm very, very still bullish on London. Not so bullish on Toronto and Vancouver, though I think immigration will continue to ensure that the markets stay propped up because people are coming here. Canada is a safe haven for capital, and it's a really safe place to be. So people are just really, really, they're really cognizant of the fact that honestly, I don't know. Canadian real estate, there's some risk factors too, right? We have interest rates, could cause a huge issue. Our economy could destabilize. We're in a trade war with the United States right now, kind of back and forth. So I don't know how that's going to play out as well. Certain geopolitical factors could then be a boon, could be a boon for the economy, or they could be, really bad for the economy too, and cause us to go into a bit of a bear market. That's why I recommend buying for cash flow. If you're buying properties that cash flow at the 1% rule, I'm buying $150,000, $200,000 houses that are bringing in $1,800 a month plus all utilities. My mortgage is $900. I got tons of margin, right? And when the economy tends to drop a little bit and people can't afford, right? Interest rates rise, people can't afford housing, the mortgage payment's too high, so they go lower in the market. Instead of buying a $400,000 house, they buy a $300,000 house. It's the Canadian dream. Like, Canadians love owning houses. It's just like a thing. We just feel really good about owning houses and cottages. It's a thing. So as long as that trend and that demographic continues, I think among my generation, and especially the baby boomer generation, I think we're going to be fine as far as long term in that price segment. But I think the $800,000 houses could see a huge drop if there was no demand for them. They would stay on the market for a long time, and people sometimes are forced to sell. Imagine a $1 million house at 9% interest rate. You get $90,000 in interest every year, just in interest. Forget property taxes and everything else. Most people can't carry that, right? So if interest rates were to rise, no one could carry those homes, right? And they'd be begging someone to take their mortgage. Like, they would sell their house for $1 if you just took their mortgage. And that was what happened in the 80s and 90s. Apartment buildings, went for $1 because people just couldn't carry them. The interest rate was too high. There was not enough cash flow, and people were buying as speculators, and that's not a smart thing to do. But let's get to some questions here. Okay. So for a BRRRR, to answer your question there, Michael, how much cash do you need for a BRRRR? I think that's really, really important that you have enough cash to be able to at least get the renovation partway done. You don't want to get halfway through the renovation and run out of money. If you're a really, really frugal guy, I think you can take a lot of your day job income, or whatever you're doing for your normal 9 to 5, funnel that income into your rental property. So you could have 20% down payment, buy the property, because you want to refinance with a BRRRR. So you need to be able to refinance 80% loan to value. So if you bought it 5% down, it's sort of hard to do that unless you do 5% down with a purchase plus improvements quote, and then you can pull that money out. But so yeah, 20% down, and then you need the money to renovate the property to get the refinance out, to pull your down payment out of the property again, right? And have no money down. So yeah, I think that, that's definitely something to consider as far as when you're getting invested in BRRRR real estate investing. Best thing to do too is partner with someone. Do a joint venture partnership, and they might have the income potential to get you a mortgage. Maybe they have the capital, and you want to work. You're a workhorse. You're like, I'll do all the renovation. I'll hustle with the tenants. I'll do everything. You don't have to do a thing. Just provide the capital, and I'll give you like X amount of return. And that's something that like people now message me and say, I don't want to do anything, but hey, Mike, like, would you with your property management company take care of everything? Like, find me a deal, bring it to me. A really sweet deal attracts money, right? At the end of the day, if it's bought below market value, people double their down payment immediately on close, plus they get cash flow. I mean, you can't go wrong, right? If you're buying smart. So that's something to think about. Okay, next question. Rapid fire. Yeah, it depends on the property. Every rent budget's different, Mike. If you're beginning in Toronto and start investing, honestly, I would just say rent, or invest in a different market. Pick up an investment in a REIT, a real estate investment trust, is a fantastic way to get your feet wet in real estate. You get about 10% return. REITs, the collection of good REITs, has actually outperformed the S&P 500. So people talk about like Graham Stephan, and I've heard a lot of the people shit on REITs, but REITs are actually great. Real estate investment trusts are basically a company goes and they invest your money, they lever it up for you. They take your money and they lever it up 3 to 1, and they buy real estate. And they manage real estate, and they're more effective and more efficient because they're managing a huge portfolio of properties. They deal with all the stress. They do take a fee for themselves, it's true. But at the end of the day, if they're delivering a 15% return on investment, they take 2 or 3%, you're still getting 12%. Real estate you can use leverage, right? Most businesses can't use leverage the way you can with real estate. If you're a real estate business, any bank or big financial institution will dump money into real estate. So that's something it's one of the safest things you can use to lever up. And that's why I like real estate, because the downside is so limited. You just sell your property, typically for like more than you bought it for, or at least at break even. So it's hard to lose money in the business of real estate. But let's go down to the next question. Okay, let's talk about the TSX. Well, the TSX, this was Nicholas. Will the TSX be hitting a new high today? Where do you see the market going from here? I'll be honest with you guys. I had an issue today with a contractor. We had to separate ties, and so I have a project now that I need to find a new contractor for, and so that consumed most of my day, along with a few other issues that kind of cropped up at the properties. And actually, I bought a property today. I put an offer on a property in the morning, and it closed today. Got a property for 125 grand. So if anyone's interested in that, hit me up. Maybe we'll joint venture it or something. 125 grand. I think it'll rent for 1,400 a month plus all utilities. So we're way over 1% rule. It's not in a great area, but I got a plan to buy a few more houses on the street and gentrify the neighborhood. So that's one strategy that can work. If you buy all the houses on the street and renovate them all nicely and get rid of all the scummy people that live there and bring in great quality tenants that use screen, you can actually gentrify a neighborhood and create appreciation. That's the only type of appreciation I believe in, is when you're the one gentrifying the neighborhood. Don't rely on other people to do it. You do it. But you have to have deep pockets to do that. You know all about what's going on, Jonas. So I did pick that one up today. So they took our offer, and it doesn't need a whole lot of work. I think there's totally an opportunity there for this property. Cash flow is strong all day long. I'm going to try to get, the idea would be to own the area, right? And that's the key piece in transforming that area. Gary, I'm doing great. Thanks for the message there. Appreciate that. Okay, going down here to do scrolling. I totally agree with you about wholesaling. I also buy distressed properties, renovate them, and then put a tenant in them. And I'm from New York, but I fly out to Florida for my rentals. Interesting. I know some people who invest in Florida and like Orlando and places like that, and they've done very well. The market has been very favorable the last couple of years in that market. My in-laws have a place. They have a cottage, not a cottage, a trailer, I guess you'd call it, like a full-time trailer. They use snowbirds. They come there for a few months. And I go down there and visit them on occasion. It's been about a year since I've been down there, but when I was there last, I saw a ton of opportunity. The rents were really strong compared to house pricing, so there's a huge opportunity there. Definitely recommend that, and it's a beautiful place. Florida is an awesome place to travel to. They have Disney and a million other things that attract people to the state, and so yeah, that's amazing. I personally like to live close to my rentals. I like to be able to touch them, but if you have a good manager or some family or people in town that you can trust and count on to take care of your property for you the way you'd want to take care of your own property, I think that's a sound strategy to invest, in those sorts of markets. So awesome. Great to hear that you're investing. So the TSX, where do I see it going? I haven't, like I say, I got on a tangent about the whole issues I've been having today with someone who's working on my team and now no longer. I think that the TSX has been flat. If you look at a 10-year map of like 2000, I think it was like 2009 to like 2008, about a 9-year period, the TSX has almost been flat. If you look at certain trends, we've had a terrible run the last like 7-8 years on the Toronto Stock Exchange. So that's because the Toronto Stock Exchange encompasses mostly like financials, and it's very like natural resources heavy, like energy sector. There's certain financials. There's certain companies in the TSX that are Toronto Stock Exchange that are heavily weighted to one sector, and they just haven't performed all that well. So we've had really, compared to the S&P 500, the Toronto Stock Exchange has just done terribly. Like, I think if you look inflation adjusted after dividends, it's like you haven't even doubled your money in like 10 years. That's terrible. You want to double your money every 7, so you're getting like a 5% return. I've not been really a big fan of the Toronto Stock Exchange as of late, just because of the poor performance. I would say it's better to build your own portfolio of ETF exchange traded funds that hold like dividend plays, companies that provide solid dividends, because solid dividends, no matter what happens to the price of the underlying stock, I think that as long as you're getting a solid, healthy dividend, you're okay, even if it only moves 5-10%. So that's my thought on the whole thing. Again, I haven't spent enough time analyzing the market as of late. I've been focused on real estate, going hard. Like I say, I'm building a property management company and a few other things with a friend of mine right now. So we've been just spending a lot of time renovating real estate, trying to find real estate deals, and then connecting people to those deals, as well as managing a lot of properties, a lot of tenants and concerns and stuff. So that's been consuming my day. I have a pile of cash that I would like to invest in the stock market right now. I've just been, honestly, I've been afraid to jump in. I think that there's a correction that needs to happen. I don't know when that's going to be. And I know that the general advice is you should have time in the market, not timing the market. But I'm just waiting for the right opportunity, the right investment. There are some ETFs I've been looking at that follow like lending companies. I think that's a solid way to invest because you're getting a solid rate of return adjusted to basically the rate of inflation. So that's sort of a safe way to play on the sidelines and then sell if you need to buy in when things are cheap. So that's sort of my thought on equities right now. But who knows, right? It could go another 10-20% higher. I missed out on Bitcoin, obviously. I sat on the sidelines saying when it's going to crash as it went 10,000, 12,000, at 20,000. I still didn't think there was any value, and I still don't think there's any value in Bitcoin. But will you ever exchange your properties for an apartment building, or do you prefer holding properties you have now? Pros and cons. This is a long question. So, Michael, maybe. The answer is maybe, and if the numbers work. Right now, a lot of the deals I've been looking at, apartment buildings, large ones, are operating and selling on a 6 cap rate. 6 cap rate is terrible. Like the return is just not there to justify the purchase price. So they're basically too expensive to the amount of rents they're getting. And in Ontario, it's very difficult and hard to remove tenants. Like, how do you remove a tenant? It's just so difficult to guarantee you be able to switch out all the properties, like all the rental units, right? And have all the tenants change out. That's a difficult task and difficult ask. There may be opportunities to do that where you can get, like, people are renting 2 bedrooms for $500 a month, and the market rent is $1,200, $1,300, $1,400 in London. We've seen a ton of rent increase. And so that's, I think that things haven't caught up. And so there's not really the value there in apartment buildings. I just don't see the fat enough margins, but you have such huge size, right, and scale. So imagine like an 8% margin, an 8% profit on a $10 million building is $800,000. That same 8% margin on a $100,000 property is like nothing, right? We're talking like a couple $1,000s after everything. So it's not worth your time. So in single families, you just get way bigger margins. And if I had more institutional money and institutional capital, like institutions, so any institutional investor, any large investor doesn't want to touch single family properties. So if someone taps me on the shoulder and says, hey, Mike, you're a great guy. I've been following your journey. We've got like $10 million in this fund. We need like a 4% rate of return. That's what we want. But we want it super, super safe. We don't want to touch any residential real estate, commercial only. That's when I would take that capital effectively and invest in townhouse units or like apartment buildings. The nice thing about apartment buildings, pros of that are you have everything under one building. You can have one live-in manager that handles all the problems. With single-family properties, you need a manager that's on call that deals with 100 different properties. I'd rather have 100 units in a building stacked together with one roof than have 100 properties separated, right? But the problem is right now in London, Ontario, in the market, 100 properties way outperforms a 100-unit apartment building, like way outperforms. And I'm talking price to price, like 100 properties worth the same as a 100-unit apartment building. Like I'm getting like 12 cap rate on some of my rental properties. So when you're getting double the ROI with single family, I'm willing to have a little extra stress. I make the tenants cut the grass. I make them shovel the snow. I make them do everything. I don't even go to my properties. Like other than if there's a maintenance request, I hand it off to someone and they go to deal with it, right? I make them pay all the utilities. Everything is taken care of. And if you run, I think, with an efficient system, efficient strategy, single family rentals have way higher ROI. It depends on your market though. Like some markets, I think, there's not a lot of institutional investors, a lot of commercial investors. So maybe apartment buildings are more affordable. Maybe you have higher vacancies in your area, so apartment buildings are more affordable. Maybe you find one that needs a lot of renovation. Again, there's an opportunity there. So I can't say there's negatives to like just investing in apartment buildings. There's obviously pros and cons to both, right? And at the end of the day, you got to ask yourself, what's your goal, right? Is your goal just to be like super wealthy with no purpose, or is your goal to unlock financial freedom? And for me, it's financial freedom. I've sort of unlocked that financial freedom, but I'm still moving towards making sure I have enough, right? And I worry like, what if we have more children? What if I have more kids? Or what if my daughter gets a weird health illness? Or all those what ifs that I know are irrational, but still motivate me to keep moving, right? So it's like I back up and I'm like, oh, this could happen, or the market could collapse tomorrow, and like, do I have enough reserve? And 2 houses could burn down, and insurance might not pay for it, and whatever else, right? And it's irrational, crazy thoughts. But and then I start thinking forward, and I'm like, you know what? I'm gonna be fine. I am financially free. Just do what you love, right? And so at the end of the day, if you enjoy, like I actually enjoy. I'm a people person, so I really enjoy placing a tenant in a good unit. I enjoy renovating a property to a good standard, and when I get to deliver that, I really enjoy it. And so there's some joy and some fun in that. I like to outsource the things I don't enjoy. I hate renovating. Done a ton of it, but I hate doing it, so I try to outsource all of that. Having, today with the issue with the contractor falling off and the project having no one on it now as the main guy, that gives me a ton of anxiety and stress. Like days like today, I'm like, I'm done. I don't want to be renovating. I'm so tired of this, right? But then, I'll solve the problem. I'll find a solution to the problem. I'll make a bunch of money, and the problem will be, it's a short-term pain for a long-term gain. And so I just kind of accept that fact, right? And I'm going to keep going with the questions here. Sorry if I didn't hit enough of your points. Ask another question if you found that wasn't sufficient answer. Okay. I hear the CRA watches for individuals claiming ownership and income on a property that they aren't on title for, a JVU working partnership. What kind of structure do you recommend for growing your portfolio? Travis, that's a great question. The Canada Revenue Agency, CRA, does, yes, they do not like when someone has 100% title and someone else really put up half the capital and isn't claiming the rental income. My thoughts are, if you're joint venture on a property, right? If you're putting up capital and you're investing, you're buying that property, you're not just the manager, but there's property management. That's one thing, right? That's fee for service effectively. You're trading your time for money. You might get a bonus structure if the property sells for X amount, and that's fine. But I think the CRA does want you to claim that income. So the tax man's going to want you to claim that. So when all my joint ventures, I have a joint venture property right now as an example that I showed you guys in a different video. I'm not even on title. Like my friend bought it 100% in their name. They got the mortgage. I put up half the money. I'm going to claim on my tax return a T776 for that property, 50% of the income. I'm going to claim half that income because that's the right thing to do. You have to, you can't cheat the government. They're going to find out, you get in trouble. Do it the right way, pay a little bit of tax. But yeah, so if you're a joint venture partner, you've got to claim that income on your tax return, on your T776 form, income statement for that property. Just claim it. That's sort of my thoughts. Joint venture structure can be very complex. You can do it simply. You could just have a friend buy it in their personal name, and you guys write up a 8-page joint or a 2-page joint venture agreement with a shotgun clause to what you could do if shit dissolves, and how you handle your responsibilities and your duties, and write all that out. And you can do all of that, right? I could show you guys joint venture agreements. I've done them before, and sometimes it's just a handshake. I have friends I've just handshake agreement. I trust this guy 100%. At the end of the day, I don't worry about it. So that's something that some people do when they do their joint ventures. You can structure it in a corporate. There's a 3-tiered structure that works really, really well from a liability and a tax perspective. If your income is way over 150 grand. So if you make less than 150 grand, like my wife and I, we definitely don't make 300 together, right? So for us, holding personally has been making more sense than holding in a corporation because the tax advantages owning it personally has been great. When I was renovating my properties in the first 3 years, I was spending a ton of money renovating these properties, creating equity, right? Because tenants would break shit and I just need to renovate to a new standard. So I'd renovate these units, make them really nice, and I have tons of write-offs, all these renovations. And that would create operating losses, right? Because I'm fixing these properties up, creating value, And then, and you don't pay tax until you sell the property. So I create these operating losses for myself. And these operating losses would be effectively offsetting my day job income. So I was making 55 grand for my day job, and I had losses in all these properties because I'm renovating these properties. And yes, I'm creating value, but I don't realize any tax on that value I've created in those properties until I sell them. So I've got these operating losses. The rental incomes are creating losses, and it was offsetting my day job income. So I was paying no tax at all. It was literally like offsetting most of my tax bill. So you can use rental properties in your building phase when you're building towards financial independence or whatever your goal is to effectively pay no tax at all from your day job. So I look at rental properties as like another avenue to decrease tax. But in the long term, when you sell, you're gonna have to pay capital gains tax, which is not bad. It's like a quarter at the most. If your marginal tax bracket is 50% in Canada, your capital gains tax is at like 24%. So that's the highest you can pay on a $100,000 capital gain on the sale of a property. The most you can pay is $24,000 if you had no write-offs, and that was it. Like, you really don't pay a lot of tax in Canada. People think you pay a lot more tax than you do. If you're smart about it and the way that you invest, and you're out there to make rental income, that's the key thing. I invest as a cash flow rental income investor, so all appreciation happens as a sort of a bonus, right? I don't rely on it. And the CRA sees me I'm not a flipper, right? I don't flip properties. It's not my strategy. I create rental income. I run a rental property business. All my rental income is business income. And so I'm not a flipper. Flippers don't get capital gains treatment. All of their money made from the sale of a property is pure, pure business income, because that's their business. It's what they do. That's not what I do. I build rental income and rental cash flow, and it's more preferable to do that, I think, even in a recession or a downtime. If you have to hold a property for a year and wait for it to sell, if it's rented, you're making money all day long. Like my best properties have been ones that I held and they had solid cash flow, right? And I ended up selling them in the end just because of whatever reason. But because I had that strong cash flow, I wasn't losing money the whole time with carrying costs. So I'm not a big fan of flippers. I think flipping is actually a terrible business. I've seen a lot of flippers lose money. I've seen a lot of good flippers lose money. The last 5 years, it's hard for even the bad flippers to lose money because market appreciation is such that people are just making money hand over fist, making bad business decisions, hiring bad contractors, bad material costs, letting everything get out of control, and they're still making money because they're just investing in a market that's going like this, right? It's kind of hard to lose money. And so those guys, I say, you didn't really have any skill. You just kind of were lucky. And there's a lot of lucky investors in this market, and that's fine. Just don't rely on that as your investment strategy because stuff might go sideways, right? So how would I invest? Alan asked, how would I invest $5,000 as a beginner in real estate right now? If I didn't know anyone to joint venture with, because I would try to joint venture with someone and get a small piece of a project. But let's say you didn't know anyone, you had no network. Go buy a REIT. Go buy a real estate investment trust. A public REIT is fantastic. You can put your $5,000 in it. They'll take your $5,000. They'll put it into like a dozen, like probably 100 properties, right? They'll sprinkle that little bit of money everywhere. And in each project, they're going to lever up your $5,000 into $20,000 of buying assets. So your $5,000 in a REIT will buy $20,000 or $15,000 in real estate, like in total assets. They'll generate, say, an 8% return on investment. So you lever up really, really well. Hey, Noel, welcome on to the show here today. Wise Wealth Wednesdays. We're doing Q&A right now, just getting through some of the questions. We're talking about specifically, what were we talking about, guys? I completely lost my train of thought there. The question came up and we were talking about, remember what we were talking about? Oh, he's drawing over here. Kyle's over here helping me with my camera stuff. Someone shoot in the comments. I don't remember what we were even talking about now. I've lost my train of thought. I think we're talking about REITs or something. But sorry, I'm really tired, guys. I didn't have a good night's sleep last night. We're talking about what would you do if you had $5,000 and you wanted to invest in real estate. Well, you probably can't buy a property with that, and you don't know anyone to invest with. Thanks, Nicholas. Appreciate that, guys. Travis, for jumping that 5,000 there. It jump-started my thought process. At the end of the day, when you think about it, you've got this $5,000 and you can invest in a REIT, a real estate investment trust, and they'll take your $5,000 and they'll buy $15,000 in real estate. And you're paying like, whatever fees to them to manage it, but who cares? Like, if I told you if I could double your down payment and like, if you could give me $50,000 and I can give you 100 back, you don't care if I took 50,000 in fees because you got 100 back, right? So, I mean, as long as they're, look at what the REIT's investing in. If they're investing in strong cash flowing properties and they've got a recession-proof sort of strategy, I think you're going to be okay. Make sure you're investing in the right REIT. There are a lot of terrible REITs. Do some research, guys. I'll drop a link in here in the comments later when this video gets published about REITs outperforming, so real estate investment trusts. Real estate has been outperforming the S&P 500. So investing in REITs outperforms the S&P 500 if you look at the historical data because of leverage. Companies can't borrow as cheaply as REITs can. A REIT can borrow at like 3.5%, 4% and buy assets that produce 10, 12% rate of return. So when you lever that up 4-to-1, you get 10% rate of return, you make it 40%, right? And even if you take a ton in fees, there's still money left over to give to the investors. So best way to get started is to just invest in a real estate investment trust. There's some private mix and private real estate investment trusts you can look at. I think you have to be an accredited investor to get involved in those. So maybe just look at the public ones that are publicly traded tickers. And I'm sure you could do the research and find one or two that align to the investment strategy that you want to invest in. So maybe one that focuses on like student rentals if you like that, or one that focuses on commercial. There's a lot of commercial REITs, and I hate, like I'm bearish on commercial REITs. Stay away from commercial REITs. Office space is becoming obsolete. People work from home. They don't need the office space they did. Retail's dying. Everyone's buying on Amazon. Myself, I'll go into Best Buy, look at something, and I'll go buy it on Amazon. So I think that commercial office space is shrinking. And so there's like less and less need for it. And there's tons of buildings that exist, especially in London, Ontario. Stay away from commercial office space. So there you go, guys. That's sort of my thought on why you should invest in REITs, but specifically look at REITs that are investing in a good, maybe single families or certain strategies that they use to generate a really good ROI, and one that's recession proof, like single family rentals. You're not going to go wrong there as long as they're diversified. They're not all in like one market, right? As long as they're in many different markets or in a market that you really believe in and trust, then you'd be pretty safe, I think. Invest your 5,000. In the last 7 years, you look at the historical, you should be able to at least double that in REITs. So a lot of people, if you look at the historical data, have taken 5,000 in a REIT and turned it into $15,000, $20,000. And that's completely passive. Like you just buy this and that's it, guys. Like it just, you double your money, right? So that's sort of a nice way to invest passively in real estate. And guys like myself who are doing this professionally, right? And we know how to manage properties. There's guys at REITs that know how to do it even better than I do probably. They have better systems and economies of scale that you can kind of get a piece of and leverage into. And yeah, there's a little bit of a fee, but I would say that the gains that they give you are better than the fees. So despite what Graham Stephan and Meet Kevin and all those guys who don't like REITs say, they are also real estate agents, and I'm not a real estate agent, so I'm a real estate investor. And I think as a real estate investor, if you want to be 100% passive and have no headaches, no phone calls, invest in a REIT. And I'm going to do a video on this, guys, because people shut on REITs, and they're not bad. There are some good REITs out there. Okay, let's keep going with the questions here. I'm scrolling. Okay, Who do you recommend going to for coaching and mentorship in wholesale real estate in Ontario? Alan, it's a good, wholesaling is a great way to get involved in real estate if you don't have any capital either, because you can put up just like a $2,000 deposit to lock up a deal and then sell that to someone for $5,000. I paid up to $14,000 for a deal to a wholesaler. Like I would just give them $14,000 cash. Thank you for giving me that deal. So you can make a ton of money as a wholesaler. If you're getting a deal a month at 10 grand a month, that's 120 grand a year as a real estate wholesaler. And all you have to do is knock on doors, put out flyers, get to understand real estate, because you need to be able to understand real estate to put together an offer for them. But if you can get a deal hooked up, that's at the end of the day, that's valuable. I have some friends who are looking at creating a wholesaling course. If they drop it, I'll do a video. I'll in a comment, I'll message. If you message me privately, I can send you their information, and they'd be happy to coach you through how you go about starting in wholesaling. I can give you, we could talk offline about how you might get started in wholesaling, some strategies that I've used to lock up private deals. I'm not a wholesaler, but I've locked up lots of private deals. I just don't assign them. I just keep them for myself and for my investors and friends. But yeah, okay, that's how you get involved. And mentorship's key. I think it's better than coaching. If you can find a mentor that will help you out for a cheaper fee than paying like the $25,000 courses and stuff like that, you're better off just saving that money and using that, investing in the business yourself. Jonas, yeah, humble wholesaler. Yeah, I don't know about his course. I can't say anything about that one. He's not the person I was thinking of, but maybe his course is pretty good. I don't know anything about it, but he's obviously a good wholesaler, so I do know that much. How would you structure a joint venture with a new partner? Sort of gets back to the other question. I'm not sure how you would structure it. It depends on the deal. So some deals are sweeter than other deals. And if a deal's really sweet, like if I bring someone a deal that's worth 190 and let's say I bought it for 150, there's $40,000 instant equity, like conservatively, you're safely getting $40,000 and your down payment 150 is like $30,000. If I can give you your down payment back, I might take 10,000 of that. Let's say I was doing the joint venture structure. For bringing you the deal and taking the management and all that, I might take 10,000 of that profit. I might say, hey, give me a quarter of the profit on close, a quarter of the deal, right? But you're still putting up 30,000. You could refinance your 30,000 out instantly, right? So I mean, you get a double in your down payment. You have no capital in the property if you refinance it. Who cares if I get, if your joint venture partner, I get $10,000 out of it, because you are effectively making double in your down payment, plus you're getting $500-600 a month cash flow. I mean, who cares? Like, same thing with wholesaling. People say, I'm not going to pay someone $14,000 for that deal. And I have friends who would say, no, I just wouldn't do that. And I'll give someone $14,000. If a property is $90,000 below market, I'm happy to give them 14 grand. No problem, all day long. So that's something to think about. Don't be afraid to spend money to make money. That's something that I'm a really frugal person. You guys know, I'm super cheap. I live in my family here, we live in a duplex with a tiny house, and I live for nothing. My mortgage payment's fully covered from the other unit. My food's covered from the lower unit. My other units in the property I live in allow me to live for free. I live on probably $1,000 a month. People say how do you live on $1,000 a month? That's insane. Yeah, I save everything I make because I live so frugally. I don't go on lavish trips. I'm just so frugal in every area. But then when it comes to business, I had to switch thoughts and go from it's okay to spend money to make money, right? If you got to spend $10,000 to make 50, it's worth it, right? Just don't throw good money after bad, right? Don't throw $10,000 on a lavish trip with an employee and then get nothing out of that, right? It's a bad capital investment. So just make sure you're careful in how you allocate that capital. Don't be afraid to spend money to make money. That's something that as a really frugal person, that's something that's been hard for me to overcome, but I've learned that several times. Sometimes you got to spend money and invest in quality over, sometimes a quality contractor or a quality renovation product might be more expensive at the outset, but save you a ton down the road. So that's sort of something to balance out and think about. Depends if it's a commodity type product or not. Lumber, who cares? All lumber is pretty much the same. I'm not going to pay more for it just because they say it's, smells nice. Okay. Hey, Mike, what is the best way to invest 10,000 Canadian? What do you think about investing in Canadian weed companies? So it's getting a royal assent soon in Canada that marijuana will be legal. It will be heavily regulated and licensed the same way alcohol and tobacco are. It'll be taxed, which is fantastic. I think most of the growth we've already seen with some of the weed stocks in Canada. I followed that growth. I didn't get on that trend. I had a lot of friends who really rode that curve. I wasn't sure whether I don't like to bet on legislation. I just don't like to take risks like that. When I invest in something, I don't want to invest for legislation or take a risk on. I don't want to speculate. I'm just not a speculative investor. When I buy a property, I know I can rent it for $1,400 a month, and I know I'm making $600 a month no matter what. I bet on myself. I'm confident in myself. I'm not confident in whether Justin Trudeau is going to get this bill passed through the Senate, and who knows what could happen, right? So I don't bet on political economic events. I rather rely on what we already know and try to mitigate those political investment decisions. So you could do well. I think this is my personal opinion, it's not investment, advice or anything, but I think that when things pass through Royal Assent, it's officially legal. In a month or two, a lot of people that weren't even following the news are going to start realizing marijuana is legal now, right? And so I think there'll be a big buzz in Canada for 6 months about that. And I think some people will get behind some of these companies. And so we're going to see a spike. You probably see a little bit of a boost. And if you wanted to be a bit of a speculative trader, you might invest in some weed stocks now and see that boost and then sell off once that hype is over. So that's one strategy you could use, not one that I would implore on. I'd rather be I'm a conservative investor. For me to losing 10,000 is way more painful than making 20,000 is making me feel good, right? So I feel losses really, really heavily. And so I mitigate my downside so hard, guys. I'm an upside. I like the upside. I'll buy a property for cash flow, but I'll also buy it if it has potential. If it doesn't have potential and cash flow, I don't want it. If it's just turnkey and there's nothing to do, there's no market upside, it's in a crap area, and there's nothing that I think can gentrify the neighborhood or whatever, and there's no renovations I can make, no strategic way I could squeak out some profit out of this unit, it's not enough. It needs to have cash flow and arbitrage for me. There needs to be an opportunity to create value and an opportunity to have cash flow. But cash flow is number one. You can't buy to speculate. If you're buying a property and you're breaking even, or you're buying a property and you're making $200 a month, you can do better. That's all I gotta say. A lot of investors I've met here in London and in tons of markets in Toronto that make $300 a month on a property. And I'm happy. I'm making $300 a month. And I'm that's awesome. Power to you, do you, right? But there is a better way, I think, to invest. And, if everyone was doing it, then I wouldn't be able to make the arbitrage opportunities I'm making. So I guess people out there keep doing what they're doing so I can keep making all the money. That kind of works out. But anyway, I'm trying to educate you guys. If you want to follow my strategy, cool. If you don't, some people message me and they're like, Mike, cash flow sucks. It's all about speculation. And, you know, I want to buy in or I bought in Vancouver and I made $2 million. And I'm like, that's sweet. Like, that's awesome. I'm so happy for you that you made that money. That's amazing. Like, I wish I made that kind of money. I didn't. But you know what? At the same time, if the market had crashed, I'd be fine. I'd still be cash flowing and you'd be, you know, underwater, right? So you took a lot of risk to get that reward. So something you got to factor in and think about. Okay, let's keep going, guys. What's the best way to estimate market value for a property? Would you suggest a new investor go to Geo Warehouse, or are there cheaper, better ways to get market value? So Geo Warehouse is a tool that realtors use to pull comparable properties. So there's 3 ways I did a really good video on this, guys. You should check this out. How to get a rock star property appraisal. I should probably rebrand that with a better thumbnail and then push it, like relist it or something so you guys can find it, because it's a great video check this out after the live stream, because I talk about how to get a good appraisal on a property. And to get a good appraisal, you have to understand how an appraiser values property. How do you value property? And you know, I did a bit of research for that video, but I'm not as crisp as I was when I did that video. But you know, the 3 things I know are that you use either a comparable analysis approach, so you find comparable properties in the area, and you adjust for things like number of baths, square footage, yard space, shared driveway, not shared driveway, whatever, right? A number of things. Sorry about the lag there, guys. You're investing in all those things, and you take those comparable properties and you say you pick 3 that are the most comparable, and that'll kind of tell you your value, right? You'd average those 3, or you pick the best 2, you'd average those values to give you, hey, this is what the value of my property is, comparable analysis approach. Problem with that is when investors from Toronto come in and start paying $100,000 over asking in a quick spring market, the comparables start jumping property values like $100,000. And the other 2 ways to appraise property doesn't kind of catch up, right? The other 2 ways are, and these are the ways I like to value property. I do look at the comparable analysis approach, take it under advisement, because that's what appraisers and most of the market today is using, right? Like most people are using that approach to value properties. Second way, so you got comparable analysis approach to come to value of a property. Second way is the call it net income or cash flow approach. I don't know what the exact name of it is, but you effectively you find out your net operating income for the property, and you say, okay, what is that? And then you divide that by the cap rate in the local market. So in my market right now, appraisers are using an 8 cap rate. So they'll divide by 0.08, right, like 8%. And that'll give you the value of your property, right? So if you're bringing out, I don't know, you guys are looking at my phone, so I can't even do the calculation here, but let's say you had a property that's bringing in, I don't know, $10,000 a year. You divide that, say it was a 10 cap rate, you divide it by 0.1, that would give you a $100,000 valuation at that rate, right? So that's one way to value property. Would you ever turn down an appraisal because it came too high and you end up with a deficit each month? No, I'd never turn down a good appraisal. Take that appraisal at bank, and it never happens. Like the banks pay for the appraisals, so your appraisals are never close. They're always below market value. The appraisers are always conservative, and it sucks. You can never get full market value out of an appraisal. You get like 1 in 5 appraisals are like good, 1 in 10 probably. And there's strategies in my video. I talk about ways to get good appraisals. Always pull the capital out. If you can't pull it out at market value and still cash flow, you didn't buy right. That's my thought. In which case, if you didn't buy right, think that through, you should sell it, right? If the market value is such that you can't cash flow it, you sell it. You adjust your portfolio. I'll adjust all the time. If I'm going to have a property in a great area and I bought it for $200,000 and it cash flows $2,500 a month, it's a great property. I'm like, okay, it's an amazing property. It goes up to $450,000 in value, right? I don't want that property anymore. It's not a good property. I can get $450,000 for it right now in the open market. That means it's nowhere near. It's like a 5 or 6 cap rate, and that's happening. That's why I sold some of my properties, guys. It wasn't just stress. It was partially a rebalancing of your portfolio. You should run your real estate portfolio like you run your stock portfolio. And if a stock jumps up and your portfolio is now 40% weed stocks, you need to sell some of that off and rebalance, right? Back to the original asset allocation. I do the same thing with real estate. I run my real estate business the same way. I'm going to sell that $450,000 property. And of course, I'm going to take that and then go in another market somewhere in London where I know there's still arbitrage opportunities. I'm going to buy 2 more for $225 and $220. And there's my $450,000. And now I got, instead of $2,500 a month in rent from the $450,000 property, these 2 $200,000 properties are bringing in $2,000 each, let's say. And I got $4,000 a month coming in rent. And the same mortgage payment because the value is the same. So you just rebalance your portfolio. If properties come up in value, you just sell the property off. People are irrational about real estate. I don't know why. Like they like this property a lot, so they don't want to sell it. They make irrational decisions based on emotion, based on fear, based on tenant issues. Often, that's how you get a good deal, right? Someone floods a basement, it's like a $2,000 repair. You can get $30,000 off your purchase price because the landlord's freaking out. He just wants done with the tenant. Or the tenant comes and assaults him at a unit, like punches him in the face, says, I'm never paying you rent. I go in that landlord, and I guarantee you, he'd be fine to take like 10 or 20,000 or 30,000 off the purchase price to not have to ever deal with that tenant again. And I might be able to go in and rationalize with that tenant and say like, hey, you know, you're a reasonable guy. I understand things got heated. Let's work out a solution, right? And if you can't work out a solution, what's the price to leave, right? What's the solution? There's always a way. Maybe you have to pay their moving costs. Maybe you have to find them another apartment, but there's always a way to work with tenants. I honestly believe like 99% of people are rational and reasonable and willing to work with you and find a solution. So that's sort of been my take on things. Hope that kind of answered your question there. I know I get off on tangents, and just rein me back in, guys, if I go way off. Hopefully that helps. The third approach I forgot is appraisals, right? So we're talking about comparable analysis, income approach, determining value. I use income approach first, and then I look at the comparable analysis approach. But the third way is the cost-based approach. So what did this cost to build? What would be the replacement value of this property to rebuild this house? What is the land worth? Add those things together. What renovations were done on the property? They use the cost-based approach in like mansions or like properties they can't find good comparables for. So they'll say like, oh, this mansion, you have a bill, you showed me it costs $800,000 to build. It's in the middle of nowhere. There's no comparables, and you're not renting it out. You live in it. So there's no income. Income approach doesn't make sense. Comparable analysis, we can't find any comps that have sold. Comparable analysis relies on the last 6 months. So if nothing's sold, if you're in a market where nothing's selling, you can't use the comp analysis approach because there's nothing selling. There's no way if there's no volume of sales, you can't determine what the market value is unless you use a cost-based approach. I like to use all three when I evaluate a property. So I'll often go into a property and say like, what is the comparable value of the property, or what is the replacement cost? And then I'll work down, what do I need to do? New roof, I got to put on a new roof. Okay. Renovate the basement, I got to renovate the basement. I cost that out, whatever. And so that'll help me determine my ARV, my after renovated value. And I'll kind of look at all of that and say, is there enough margin at the end of the day for me to still make some money, right? At the end of the day, am I still gonna be able to have enough for me for it to be worthwhile? I'm not gonna get out of bed for less than $5,000. Like I won't even touch a real estate deal. If at the end of the day, if my costs are like not making me 5, 10, 20 grand in value created, it's not worth my stress or my energy. Like I can do a lot more with my capital, my time, than like a lot of people will buy property, they'll spend 50,000 in renovation, they'll buy it for 100, spend 50, and they'll be at 150 and the property's worth 150. They weren't smart about calculating their numbers and spending their dollars wisely to increase property value. They're renovating it based on what they liked, based on the aesthetics and things that just sometimes don't matter, right? So just be smart about how you invest in real estate. And those are the three ways that you value a property. Boom, boom, boom. Comparable analysis, income, cash flow approach, and the cost-based approach. And those are the three. That's what appraisers use, for real. That's it. Only three ways to value a property that I know of. Off the top of my head here, Okay, agreed. Thank you. Thank you, Eugene, I appreciate that. What property improvements would you recommend from your experience to build equity faster? Certain strategic kitchen renovations can add a ton of value. I always add bedrooms and bathrooms. That's the best way. It's a better utilization of square footage. Often people have like a wall where it's not open concept. You can open concept a space and make it feel twice as big as it is. So it's not really about physical square footage. It's about the impression you get when you go into a property. So a 6-foot high basement that's 1,000 square feet feels way worse than like a 500 square foot basement that's 8-foot ceilings, right? It just feels, the ambience is way better. People will pay more rent, they'll pay more price for the property. So ceiling height's a big one. Aesthetics of the property is a big one. So how does it, when you walk into, what's the feel you get? So I'll spend on like nice quality floors. Paint adds a lot of value. It's a good strategic investment you can make. Bathrooms add a ton of value. En-suites add value. I can put a bathroom in for like $3,000. It adds a ton of value. I can spend $800 and put in a dishwasher in a kitchen, and that'll add $50 a month in rent. So then that's worth it. If I spend $500 on putting in laundry, or $1,000 to put in laundry in a unit, if I get $50 more to have in-suite laundry in the unit, they don't have to go to the laundromat. Think about that, right? Let's do the income approach, right? When you value a property, that extra rental income, that $100 a month you're getting for adding those two little things to a unit. If you divide by the 0.1, you get $10,000 in value, right? So you just create $10,000 of value by spending $1,000, and you've got rent coming in now from that. So that's a strategic renovation that got you more rent and more property value. It cost you $1,000. You just made $9,000 because there's now $10,000 more in value by having in-suite laundry and a dishwasher. So you can sometimes spend a little bit of money strategically, and it goes really, really far. And you get good at doing that, and you get to know what the unit needs. So some units, if you have one washroom in a 4-bedroom house, it's not going to work. You need a second washroom somehow. So I find a closet, or I find a way to convert an extra washroom in there, get a lot more rent. It rents easily, get better quality tenants. Just a number of factors that really are good. And when you think of resale, people don't want to go downstairs. You want a washroom on every floor, ideally. If you're on a second floor, no washroom, you just got one on the main floor, that sucks. Same thing, one on the second floor, none on the main floor, that sucks. People want to be able to use the washroom. They want to be able to they don't have to go upstairs to use the washroom. So it's something, little things you can add that add a ton of value to a property. And you can add a washroom for like 3-4 grand if you get affordable trades. It's not that hard, especially if the main stack is close by on a main floor. You just tie in, boom, done. Drop a toilet and whatever. Okay. So let's go down. When you refinance, is the bank writing you a check? When you get 80% loan to value, does the bank write you a check and pocket the difference from the price you got the home for the ARV? So they take the appraised value and they'll give you anywhere between 70 and 80%. Usually it's 80%. So you'll take 80% of the purchase price and they will effectively write a check, but they'll pay off the existing mortgage first. So if it's with them, they'll pay it off and they'll write you the difference. So if you have a $200,000 property, you bought it for 100, you have an $80,000 mortgage, get it reappraised at 200, your new mortgage is 160, right, at 80% loan to value. So your old mortgage is 80, your new mortgage is 160. They're going to pay out the old mortgage for 80, minus any fees, and they're going to give you about $80,000 less than any fees. Maybe there's a $1,000 breakout fee or whatever. So they'll give you $79,000, they'll write you a check for it, boom. And so if you bought the property for 100 grand and you put 20,000 in, $80,000 mortgage, so you have 20,000 in down payment. When you get the $80,000 check back, that's your down payment back. You have no capital in the project. If you spend another 30,000 renovating or 40,000 renovating, you get your renovation back too. So that's one strategy I've used on the BRRRR to ensure that you effectively get all of your money out of a deal. When you have no capital in a deal, none of your own money, you've pulled it all out in a refinance and it's still cash flowing, all of that cash flow is free. Like your ROI is infinite. If you have like $1 invested, you're getting $1,000 a month. The return is insane. Like you're thousands of % return on investment. So that's why I like the strategy so much, is because it's just like, I'm an adequate, I have an accounting and finance degree, so I should be able to trade, with a competitive advantage in the market. And I can't. Like institutional investors can't even outperform the indexes most years. So in real estate, you can use arbitrage and you can outperform the market like crazy. You take a risk, but I think with real estate, you're not taking as much of a risk as you might think, because you're secured against a real estate property. I'm gonna have to do my daughter's bedtime soon, guys. I apologize. So I have about like 5-10 more minutes. If you have any burning questions, let's get them out. Would you ever turn down an appraisal because it came too high? We talked about that one. Thanks, Michael, for the feedback. I appreciate that. What size property do you recommend buying to start a house for house hacking for the first time? So when you're first house hacking, you want something you can live in, but I think you can live in really anything. So it comes down to finding out what works for you as far as what area do you want to live in? Is it, want to be close to your work or whatever? That might help. I think as far as a property goes, a duplex is a really great place to start, or a single family with, a basement apartment. That can work out really well. Or maybe you have like, on the second floor, you get a master and you get a nice big bedroom on the main floor with a separate entrance. You rent that bedroom out and then you make a nanny suite in the basement, or a little basement apartment. That covers your mortgage. That's a great way to get started in real estate, and you house hack. So that's something I really, really recommend. It's a fantastic way to get invested in real estate. House hacking is awesome. If you can buy a property below market value too. But, okay, let's see. Is Bigfoot real? I don't know. Is Bigfoot real? I don't know. I don't really care. Yes. Your thoughts on... maybe he is real. I don't know. Okay. What are your thoughts on Trump meeting Kim Jong-un? I don't really have any thoughts. I just try to ignore the noise. I just try not to listen to the noise and the chatter of the media, and it's great. Political stability is fantastic. As an investor, as a real estate investor, if we have political stability and there's not a risk of a war, that helps Canada and the United States we take more immigrants. It makes us a more desirable country to live in, a safer country, and safety leads to better returns. People will take more investment risk when they feel safe. So the safety that Trump's actually provided, despite whatever I think about Trump, that stabilizing that relationship has been a boon for the economy, because investors don't want to I don't want to own property if I'm worried about in DC, I'm worried about a war and a bomb being dropped, right? So war is not good for it's good for an economy, but it's not good for an investor. The drive from all of the in war, there'll often be a lot of money spent on sending troops over there, and spending money to build the tanks and build the weapons and all of that. You spend a lot of money, right? The U.S. spends a ton of money on their military, right? And that drives the economy. But yes, political stability is fantastic for investors. We're just shooting the crap now. How do you recommend building your credit if you just started using debt? Establish a history. Check out that video I did. There's a lot of decent content in those 2 videos I did on credit score, how you build your credit score, you can look at the equation that I showed you on the pie chart, and there are different categories. You should focus on all of them. Go open up a credit line and start building your credit score. It just starts there, right? And if you maintain good credit and you pay off your bills, you're going to build a good credit score. It just happens, and you need that a bit of history before someone will loan to you, right? So when you're 18, it's hard to buy a property. When you're 19, it's a bit easier because you've got a year of credit history now. You've opened a couple of accounts. You've maintained good history. So that's really important, I think, and that really does help in a lot of ways to build that credit score up. And credit's really, really important, right? Even when renting to a tenant, I would prefer to rent to a tenant with a good credit score. It's the likelihood they're going to pay. The likelihood they're going to repay my money. If you don't repay lenders, why would you repay me, right? So credit score is indicative of how good someone is at paying their debts back. So a good credit score is a safer tenant, a safer risk when you're loaning. Let's see what these are saying. Do you listen to rap music? Sometimes I do. I like to get my jam on, especially when I'm gonna hit up a workout. Definitely gonna, at that time I want to hit up some rap music, hit up some beats. Of course, 100%, but I appreciate all types of music. Is it difficult to find 3 to 7 tenants that are willing to live together? Depends on where you are. It sounds like a rooming house. So if you're not near a university, most people don't want to live with randoms. If they're a group of 3 friends, that's different, right? So it just sort of depends on the area where the property is. If you're in a student area close to a university or a college, then it's no problem. All day long, you should be able to find a group of 5 friends that want to just rent a place for a couple of years. So that's my thought on that. Rooming houses are difficult, though. If you just have random guys that are like 35 working and living there, there's going to be a bit of conflict between them if they're each on independent leases. I'm not a huge fan of that. I've done that. I've had like 22 people on a property, and that was terrible. Close the door for a second. I'm going to wrap up pretty soon here. My daughter's going for bath time. Sorry if you hear her in the background there. Okay. How long after starting using your credit do you think you'll be able to qualify for a mortgage for buying a home? I think you need about a year's history to really be able to get a mortgage. But some people will take a risk, and it depends on the type of mortgage, right? So if you're going for a private mortgage, then it's not as important to have an established credit. But an A lender would be totally different, right? I know I'm hurrying. I'm going to be done soon. I heard you in there. Sorry, guys. I got to go pretty soon. I have about 5 more minutes before I'm going to have to jump off and do bedtime with my daughter because family is number 1, guys. You guys are number 2. Sorry, it's true. Okay. Do you have hard money lending? Do you do hard money lending? And if so, are you named on title? When I do hard money lending, it's to people I really trust in my local network that I know well, that are ingrained in my social network, and that it would like destroy their life to not pay me back. But yeah, so I do a little bit of hard money lending. I've done it before, mostly to friends and stuff like that. But something to think about there. If you want to get invested in hard money lending, I would recommend getting a second mortgage. Secure a second mortgage on title, right? If they already have a first mortgage, just pop a second on there. Then your capital is guaranteed against the sale of the house, assuming you don't go more than 80 or 90% loan to value. You don't want to slap, if they have a mortgage 80% loan to value and you slap a second on there for 20% loan to value, that's no good. So because if the property doesn't sell for max price, then you're screwed because you're going to get paid out last as the second secured mortgage. You majored in finance. What are some good books on finance? That's a good question. I have some textbooks that I've read. Shoot, I don't have any good books off the top of my head that I'd recommend to you guys. As far as like the basics, Simple Path to Wealth is a decent one. Like J.L. Collins writes a ton. J.L. Collins, check him out. His blog, he writes a ton of great content. Honestly, a lot of it's free. I read a lot of blogs where I find free stuff. Financial Samurai talks about a lot of cool stuff. Mr. My Mustache talks about index investing. Early Retirement Extreme is a great book on frugality, really about how you can anyone can retire in 5 years. So anyone can retire in 5 years. They follow the plan in Early Retirement Extreme's book. He just is super frugal and just saves like 85% of what he earns. And so if you're living on 15%, then you can replace that income in like 5 years if you're saving that much. Thanks again, Jonas. I appreciate that, guys. I do this because I really enjoy you guys getting value from this. Like when I get someone saying like, hey, thank you so much for this, that's worth it to me. And if I can help like even 10 people, or we had like 28 people at the peak on this stream, 28 people in here got value from this, and that's worth it to me. Like even if I make nothing from this, but if you guys, honestly, someday when I monetize this channel, which is not yet because I need to way more, watch some videos for me, guys, because I need some watch time to get monetizing. And until I monetize, YouTube won't put me in their algorithm. They won't promote my videos. because I'm not making YouTube money. So I have to make YouTube money. But I need the watch time there, 4,000 hours or whatever, to get monetized. Once I'm monetized, I think it'd be cool to do super chats. That would be so sweet. Like I would live stream all day long with someone if they wanted. I would go on live like 1 in the morning if I can make a couple of bucks, just because it's fun. And it's a cool new way. Like it feels so cool when someone like says, hey, you're so valuable to me that I would pay you like $2 right now for you to talk to me. Like that just makes me feel so good inside. It's an ego stroke, I know, but it's something that's cool and it's something I'm really enjoying. And it's the main compensation I'm getting right now is you guys telling me that you're enjoying this. Thanks, Michael. I appreciate that so much. I'm glad you guys are getting value from this because, you know, as long as you're getting value, I'm going to keep doing this. Every Wednesday, every single Wednesday, we will do Wise Wealth Wednesdays. I can do prepared content or you guys can ask questions. It sounds like people like to ask questions and it's mostly about real estate, but we can talk about spending less, strategies to spend less. We can talk about strategies to earn more money. How do you pick up a side hustle? We can talk about real estate. We can talk about investing. We can talk about earning more, maximizing your returns too, right? So how do you maximize your ROI on whatever project you're working on? Leverage is the first answer to that question. Leverage, cheap debt will help you maximize your returns. What book or resources do you recommend for those new to rental property investing? The best resource I have, and I don't like to buy books, I'm just too frugal. So biggerpockets.com. Go to biggerpockets.com. And listen to their podcast, read a lot of their articles. It's US based, but still a ton of great stuff for other people in other countries and stuff like that. Just amazing stuff. I really do think, guys, that you can watch videos like this. And I did a couple of videos recently where I analyzed deals. And I actually provided in my last video a spreadsheet, like you guys can have it, that I use to analyze deals on the fly really quick to tell you whether it's worth it or not. You know, it's one of those things where, you know, I think it really is one of those things where if you watch enough videos and you study it enough, you go look at enough properties, you'll just pick it up and you'll learn. So that's the best way to learn is just by doing, watching, learning, and then putting it into practice. So get out there and just do it. If I was that, what's that that meme? Oh, what's his name? He's always out there. He's got the long ponytail. I like him. He's in the movie Holes and Transformers and stuff. Just do it. Just get out there and do it. Okay. Thanks. Appreciate that. Harrison, it's, thank you. Appreciate that message. Someone sent a message, but it was retracted. I don't know what it was. So they retracted their message. Pretty boy Mike. I hope they mean that I'm a pretty boy because that'd be a compliment. So thank you for the message because that's a compliment, I guess. Even Steven. Thanks, Jonas. I appreciate that. Thanks, guys, for jumping in here. I know I need to get off in the next, 1 minute, right? Like right now? Okay. I got to get off, guys. As always, it's been a pleasure to talk with you guys and do the live Q&A. Tune in next Wednesday. I'm going to drop more videos, guys, trying to do video every other day. Sometimes I do 2 in a row. But anyway, this has been really valuable, guys. Please, Shia LaBeouf. Gary, thank you. That was his name, Shia LaBeouf. Anyway, guys, as always, let me know in the comments if you want to see a certain type of content on my channel. You want to see about how I bought my first property. You want to see my story. I'm going to do a video on my backstory. And it's going to be really engaging. I'm going to jump around, do a lot of crazy stuff. I'm going to jump off of a waterfall into the water and that'll be me jumping into financial freedom. It's going to be really cool. You're going to love it. I have huge plans for this. And I'm trying to up my quality, getting lighting. You guys can see we're getting some real lighting kits here and stuff's getting real. So anyway, guys, I hope you guys enjoy the live stream as always. Hey, how's it going? From Windsor? Nice. Pretty boy Mike from Windsor. Thanks for tuning in, guys. If you can, try to watch my videos and let them play all the way through because the watch time really does allow me to build the channel up and YouTube will then promote my videos. If someone can find my videos, it's really, really key, I think. Hey, I just saw your question there about the real estate and finance books. Watch in the previous video and I'll drop something in the comments for some ideas for blogs and things I like to read. So anyway, guys, thanks for joining in. We had 28 people on the live stream. That's fantastic, guys. That's an amazing turnout, and I'm really, really happy at that. At the end of the day, you guys are awesome, and I really appreciate the support. You guys are like my loyal followers, and I'm not going to forget you guys. So anyway, I appreciate that, and I will see you guys on the next live stream. Wise Wealth Wednesday, 7 p.m. Eastern, 4 p.m. Pacific. Check out my next video drop. I try to drop videos Monday, Wednesday, Friday, and at least one on the weekend if I can. So I'm trying to drop content for you guys as much as I possibly can. Hope you guys are finding value from this. Anyway, cheers. See you guys in the comments. Boop. Bye.